Okay, welcome back. We're around 65 odd points on the Nifty. 11,848 is where we're at right now. Some flashes on Jet. I think we just came. We'll address that in a short bit. Okay, let's just talk about something which I guess is of interest for anyone associated with the market. I mean, whether you're trading, whether you're a broker, even for exchanges. This matters for pretty much everyone. I'm talking about margining needs, margining requirements as far as stock markets are concerned, exchanges are concerned. There has been, of course, a fair bit of talk that margining requirements in India are actually too high. There has also been this back and forth between, association of brokers and the regulator in terms of, of course, exchanges as well on how this can be rationalized. ANMI, which is essentially a body of brokers, it has submitted a report which they had commissioned on margining in India as compared to other countries, and this report now has been submitted with SEBI. We've got Rajesh Baheti, who is Managing Director at Trossey's Capital Services, also heads ANMI, with us here in our studios to talk about what this report, which they commissioned out to E&Y, actually shows. Rajesh, thanks very much for coming in.
Thank you.
Just talk us through, I think I summarized the background a little bit, but if you want to add to it, please go ahead, and then we'll talk about the findings.
Yeah, so over the last year or two, we've been constantly engaging with SEBI and telling them the margining system as adopted may have been suitable for us maybe 10-15 years ago when we didn't have history behind us to really look at what happened in the Indian markets and the kind of movements we have in our markets. So at that time, there was an overcautious approach when F&O got launched. But having the benefit of history behind us, I think ANMI has been trying to tell SEBI that margining essentially should be a tool to cover risk in any person's portfolio or exposure to the markets, and should not be used as a tool to control the amount of exposure that the market takes. What has happened is SEBI levies three kinds of margins in India. One is SPAN, of which net exposure, short option margin exposure, a very big component. And then it over and above levies what you call an exposure margin. Nobody in the world, no other exchange in the world levies three components of margin separately, independent of each other.
One is SPAN.
So SPAN, of which short option margin is a component. In India, what has happened is SPAN being the short option margin being levied at such high levels that it's usually A or B, whichever is higher. So in India, most of the time in most hedge portfolios or professional portfolios, it is so that the short option margin is higher than the SPAN, and therefore the higher of the two applies. Whereas globally, the short option margin is kept at a very, very low level. So it's usually the SPAN that applies.
So can you simplify this down for us with a simple example, an arithmetic example? On every 100 rupees worth of trade, how much is the margin that this translates into?
So if I were to describe it in layman's terms, it's like, let's say the income tax applies on income. Tomorrow, if the Income Tax Act says, well, in addition to applying it on income, I'm also going to apply it on turnover. Well, then that is what is happening today with the margins. That what we are trying to tell SEBI, as we would have told the income tax, is that turnover does not mean I'm making money. It is just how much throughput I'm giving to the market. Just to take an example in terms of our market, let's say I do a simple call spread. Today the market's at 11,800 odd. What if I were to buy for the June expiry at 12,000 call and sell at 12,100 call? Now that's a simple call spread where the cost of the spread is my only risk to the market, and that I'm paying upfront. Now under the SEBI norm of short option margin, my 12,100 call would be considered a net short, and I would be levied a 5% margin on that. Now 5% margin on that on 12,000 worth of index is 600 rupees. So the 12,100 call is a spread of say 15-18 rupees. That is my maximum loss then I can incur in that strategy. But if I have to pay 600 plus that 15 as margin, that is about 40-50x of my maximum potential loss.
So you're saying that this is, it doesn't, the margin doesn't cover the risk, but the gross exposure.
Absolutely, because we are applying the margin on the gross short option. Now, if it's offset by a long option, then it's not really a short option, right? But if you apply it on the gross short option, it will just look at the number of shorts you have without taking account of the number of longs that you have. Secondly, we also apply what you call over and above an exposure margin. Exposure simply means you have a lot in the market, that's exposure, and there's margin.
So perhaps some of this also stems from the general aversion that regulators have, not just in India, around the world actually, to excessive leverage, and perhaps to sort of prevent any kind of a massive cascading domino effect in the event there was a lot of turbulence or volatility in the market. So what would you say to that argument, that therefore maybe margin requirements are higher because regulators in India don't want too much of leverage trading?
I would completely agree that if I'm taking a position that entails a certain kind of risk, you must take that margin from me. But let's say two of us are trading in the market, where there are only two people trading in the market. You have a portfolio that doesn't have that risk. I have a portfolio that has the risk. But excessive margin is collected from you. Collectively, it might seem that you've collected a lot of margin, but does that help? Because the margin has been collected from you who hasn't taken the risk, whereas I have taken the risk and maybe my cover is not adequate. So we are completely with SEBI when it says there should be adequate risk cover, but it should be linked to risk and not exposure. Because when you do options in the market, it's not a linear payoff that I create. I can create multiple strategies using options where I can have limited loss strategies.
This mainly covers the options segment?
Yeah. Also in the futures, for example, globally, if you're taking two positions that have negative correlation, for example, if I'm buying a basket of stocks and then selling another basket of stocks, somewhere down the line, you know, the systematic risk or what the market risk will cancel each other out because I'm going long as well as I'm going short. So the net margin is never A plus B. It is A plus B minus some component of the hedging that I'm doing. In India, it's directly A plus B. So even if I'm doing an index arbitrage, let's say I buy 15 components of the index and I sell the index futures, globally I would get that set off. In India, I don't get that set off. So even in the futures, inter-commodity spread set-offs are available globally. We don't give it.
And will some of this, we've been sort of running the graphics of what the findings of the report are, and you submitted it to SEBI. Are they receptive?
Yes.
Have you heard back? I mean, how does this go from here?
Yeah, so what has happened, because we've been, I'm sorry to say, use the word badgering SEBI over this for a long time. Thankfully, SEBI has agreed to relook at the entire margining system, and they've set up a committee under the leadership of NSE Clearing, because they're obviously the #1 player in terms of derivatives in India, to submit a comprehensive report on the complete overhaul of the margining system. So NSE is also doing its own studies, and we've submitted a study to augment what NSE will come up with, to come up with a holistic margining system that protects the market from risk. At the same time, when people do limited risk strategies, the benefit of margin offsets should be available to them.
Okay, well, I guess the regulator is at least hearing your point of view, and let's see what the new guidelines then have to say. Thank you very much for joining in and sharing some of these insights with us. Speaking of futures and options trading, let's actually get you some strategies on it for at least today. We have Krish Subramaniam joining in. Krish, it's a pretty weak day once again. A lot of bank stocks under the weather. What kind of ideas are you going with?
Yeah, to begin with, a ratio bear spread in Bank Nifty, where we are seeing some sort of weakness which could accentuate towards the close of day. So keeping that in mind, one could possibly buy a 30,700 strike put that's quoting at around 220, but correspondingly sell two lots of 30,000 strike put that's quoting at around 40. So net cost comes to about 140. And maximum gains would be 560, the eventuality of the slide continuing, and but also suggest a stop loss of 70. And stock specific put option in L&T. Now the stock has been seeing selling pressure on that higher levels. So one could possibly buy as a 15-20 strike put that's quoting at around 15 to 16. Keeping a target of 27, and maybe one could keep a stop loss of 8. And the last one is a covered call in Tata Steel. The metals have been a strong feature, and even in a market which is sliding, they seem to be holding on. So I think in the eventuality of the turnaround, the metals should actually outperform. So one could do a covered for call just to be on the safer side. Buy the futures, sell a 5-10 strike call that's quoting at around 10, keeping a very modest target of 518, and also suggest a stop loss of 495.
Okay, Krish, thank you very much. Appreciate you joining in with those trading ideas, and thanks very much indeed. Well, we're down about 65 odd points, so there isn't any recovery that we've seen. 11,848 is what the index is showing at right now. 0.7% cut on the Bank Nifty as well. It's a wrap on this edition of Trading Hour from Surabhi, me, everyone on the team. Thank you very much for staying with us. There's more coming up.